Hello, everyone. Thank you so much for joining. My name is Dominique, and we have the rest of the Greenleaf team here with us today. We have our two hosts, Dave and Avi, and helping drive this live stream, we have Natalie. We're going to go ahead and get our Industrial Flex market update started. But first, we always like to provide really just our mission and reason, our why in conducting Greenleaf Connect. Really, our mission and initiative is to be direct, informative, transparent throughout all things Greenleaf regarding our employee base or on our investor level, specifically in the projects and properties that you all invest and take part in. So we do this through our live streams, which are large events, really more for a larger public. And the private connect events are usually intended for smaller groups where there are videos on and is more intimate and interactive. So with that being said, today we'll specifically be discussing the recent acquisitions from our fourth quarter. We'll dive into market rents, reserve balances, and then at the very end of this broadcast, we will do a live Q&A session. This will be the bulk of our broadcast today. We really do want to encourage you to submit any questions that you may have using the Q&A feature located at the bottom of your screen. Specifically, if you take a look at your cover page regarding any specific investments that you have taken part in, if you have any questions about overall strategy or property related aspects of the deal, we encourage you to submit those and our team will be sure to answer them. This is a friendly reminder that this live stream is recorded and will be shared with you by the end of the week this week. All right, without further ado, I will pass it over to our hosts, Dave and Avi. Thanks, everybody.
Thanks, Dominique.
All right, thanks, Dominique. So Dave, Avi, we're very excited to talk about the industrial stuff that we have going on. To start with, we have a map here of good old Atlanta, right? So we have the deals that are in green-ish, Kennesaw Flex and Covington Flex. Those are two deals that we acquired in the fourth quarter.
Correct.
Right. So we purchased those two, and then we have 4 deals on the right here that are all a mixture of 1031s that we're acquiring. Right in the middle of those kind of 4 arrows is right where our office is. That's where we're sitting right now. So, but you can see we've got a mix of deals in almost a little over 230,000 square feet that we have in the works right now.
Yeah, and we do not show other areas here. We have other few deals in other part of the Southeast that we're still very close to getting on a contract.
Yeah, working on it. Yeah. So it's not just Atlanta. We're branching out a little bit from there, but this has been the start. And you know, when Josh and I started Greenleaf over a dozen years ago now, 85 was the main quarter that we were going up and down. So we've driven this area a ton. And then when Avi joined us, it's kind of our natural startup. We know 85 quarter the best. So everything right here is what we started with on the industrial flex front, but you can see kind of the size range too. We've got Doraville Flex from 18,000 square feet. Dawson is 87,000 square feet. So none of these are massive scale operations. They're more infill existing flex deals that we're able to acquire.
Yeah, and the Dawson Flex, it's 87,000 square feet, but it's 3 buildings. So, you know, building wise, very comparable to our other acquisitions.
Yeah. All right, so the 2 that we do have, we look at occupancy, we closed these in the fourth quarter. So we started the third quarter, we had none. The fourth quarter, we've got 2 of these deals now. So we're excited about that. And our occupancy in them is at 80%. But you look at Kennesaw here and you say, hey, it declined. So is that good? It's like we went from 75% down to 65% here at Kennesaw.
I mean, year one for any deals we buy, specifically value add, you know, you'll see that as we execute our business vision for the property, there'll be a lot of turns, and you know, the occupancy is not gonna be the highest. So that's what's going on in Kennesaw. You know, we are, you know, negotiating leases, getting new folks to pay market rents and whatnot. So that's going on in Kennesaw.
Yeah, in Kennesaw, the tenant that left there was paying about $550 a square foot.
Correct.
6, and the market rents are double that. So that's a huge delta that's there between, you know, $550 and 12, 11. There's a lot of room there. So the tenant that left at Kennesaw, we've already toured that space almost a half dozen times. They left right at the end of the year.
Yep.
So they left December 31st. And now we've toured it a bunch, and we're very confident that we're going to release this, and we're going to do that at a more of a market rate. Whereas Covington, our game plan at Covington was to go in, we're hoping to start around 85% occupancy and then lease it up. And we have 2 vacant suites at Covington as well, 2 at Kennesaw, 2 at Covington. And we're 90% now, and we're confident. Again, I mean, buying this, the market rents were way above where existing stuff was leased at. So we're going to get some revenue bumps from this, and then we're also very optimistic on the leasing in these spaces.
Yeah, I mean, we will love if the tenants stay and renew the lease and pay close to market. But if they leave, I mean, it's not the end of the world, because we will get to mark the space to market.
Yeah.
So, eventually we'll do better, even if they leave.
Yeah, we really like this space just because of the demand that's here and this gap between current and market rents.
Correct.
So next slide, we're talking about what our reserve position is for industrial. And we've gone through different reserve scenarios for our apartments, through our normal commercial, through our retail. After this, we have a retail live stream around 4 o'clock. And that one, we have different reserves there. For industrial, we have a reserve strategy specifically applicable to these assets. And it comes out to 83 cents a square foot.
Yep.
Right. So we have components for TI, leasing commissions, and CapEx. Now, the leasing commissions are lower because even on the square footage, per square foot, the overall rent in industrial is lower than, say, medical.
Yeah.
Right.
And all of these tenants who are mom and pop businesses are usually not represented by, tenants.
Two-sided brokers, right? There's
Exactly.
not like a leasing, a tenant rep and a leasing rep side.
Exactly. And because, again, going back to fundamentals, because there's so much demand, the retention is so high. So we don't expect to see a lot of turns. So
Yeah.
at renewal, we don't have to pay anybody.
Yeah. And then the tenant improvement, this is lower than we have in commercial or medical or any of those. Some of our medical build outs would be like $50 a square foot to build out. Whereas a TI improvement on an industrial flex space where you have 80% warehouse, you could add nicer lights. You could do a couple things here and there, but you're basically talking about 80% of the footprint is a warehouse that they don't want anything in, so that they can use that space. So it's only about 20% of that front portion of the building that is, and it's not like luxury office. It's not built out for medical. It's just more room, offices, a conference room that they can operate out of. So we have a slightly different reserve calculation here, but at both Kennesaw and Covington Flex, we're 100% reserved right now. So we're in a very good position. Granted, we just bought these, so you'd want to make sure we're in a good position on day one after we close the deal. So we are here. We're going to go into any Q&A we have on these 2 deals, and we're going to talk a little bit about distributions to start with. So Covington, that one had its first distribution. That distributed right out of the gates, mainly because it was occupied, 90% occupied when we acquired it, and it's cash flowing. We're able to make our distributions now.
Okay, well, you answered our first Covington Flex question. So our next question is on Kennesaw Flex, and what's the status of distributions there?
Right, so Kennesaw Flex, we are not 50% occupied, but we have 2 vacant suites. The square footages are different in those suites. And we have a bucket of TI money that was reserved ahead of time. It was done at closing. And we really want to make sure that when we go through that leasing process, that we have the right amount of TI dollars allocated and the right reserves before we make a distribution. So we have 1 tenant in there that's fully paying. Like I said, we've done about a half dozen tours so far this year on Kennesaw, and it's only 2-3 weeks into the year. So we're optimistic on leasing momentum there. Once we know what our leases are, we'll be able to project what our cash flows and TI requirements will be, and we can start making distributions there. And that was the business plan as a whole too. And that's a lot of these cases that we're looking at, right?
Yeah.
Yeah.
And when we underwrite, I think we say it's going to take us 4 months to lease these units. So,
Yeah.
so we are trending in that direction.
Yeah, we're only 2 or 3 weeks in,
Yeah.
right? So, but yeah, even the future deals that we're looking at, a lot of these are 1031s where we're rolling money out of our Hillcrest sale, our Oak Hollow sale. Those are happening. Hillcrest happened, but Oak Hollow's coming up here in the next couple of weeks. Money from those, our 1031 option is going into these flex deals where we're buying something. We have a little bit of time to do our TI improvements and lease them up.
Yep.
Our next question, is there anything you learned about industrial flex, either positive or negative, after buying your first 2 deals?
Positive would definitely be the rent split, that gap or the delta between like the current versus what the market could be is definitely significant. Positive is also, we like finding opportunities where we know we can add both physical and operational value. So we can go in, we can make these improvements, and we can also operate specific because we're buying deals that are in that 15,000 to 30,000 square foot per building. There's definite operational improvements we can make in those. So what do you think about lessons learned or something we've learned on these? I'm excited about those parts, but there's also parts we've learned.
We have just 2 transactions to close, so we don't have a ton of experience, right? And we have been operating this for, weeks. So I'm pretty sure there are lessons that are going to come.
We rounded that up to a whole quarter, right?
Yeah.
So we closed them in the 4th quarter. We rounded that to a quarter.
Yeah. We will probably have good lessons to share in the coming quarters as we have more experience, exposure to this. I don't have unfavorable findings. I think everything has been favorable. The market is trending in a good direction. All the metrics are increasing. So I don't have anything meaningful lesson on right now.
Okay. Our next is a strategy question. Is there a plan to buy single-story office and convert to flex?
I guess it depends what that single story office looks like. I'm trying to think. I feel like we have some office that's also single story and it's nice. So there's not like a flex conversion, because flex, you've got to have the back roll up doors. You got to be able to have some truck access. And normally if it's a purpose built office, it's got parking on all sides of the building, and makes it a little funky. But
Yeah. And so some of the deals that are in the pipeline, the current use is office. However, it was a flex, 10 years ago, but then the flex rents were nothing, right? So previous ownership, they converted it into office, but the structure is still there. There's roll-up door space and whatnot. So we are buying those kind of office, use flex and changing it to flex.
It's like a flex creep, maybe, where it started out as a flex structure, and the kind of that office like creeped back into the space a little bit, and we're kind of like returning it to normal.
Yeah, the last industrial webinar, Carter Oak, that we did was exactly that.
Right. So
office.
it's got some. There's an adult daycare center in there that's not using any flex. They store all their vehicles and stuff there, because the flex normally has really good parking outside of purely just, hey, we're going to line up our cars and park like you're at like a Walmart or something. This is more. There's a lot of like back area parking, and on that Carter Oaks deal, the adult daycare center, they probably have 40 vans that they're parking and leaving there overnight that are there. That's one of the benefits of a flex space.
And Nathan and I, when we get a single story office deal, we always look at it from the angle of, hey, can this be converted to flex? So that discussion happens too.
That happens frequently.
Yeah, more than you guys can imagine. Yeah.
Okay, our next question is a deal comparison question. How does the Covington Flex deal differ from or similar to the Carter Oak deal coming up? It seems like the latter is a little bit heavier value add.
The latter, so Carter Oaks is definitely a value add. When we buying Carter Oaks, the market, and again, a lot of our business strategy is not to go outpace the market or to excel beyond what's currently happening. So the market for industrial flex right now, where Carter Oaks is, is roughly $130 a square foot. And we're buying like
101.
101.
Mhm.
And then we're going to do our renovations. And by the time we're in, we'll be into it for 130. So we're really just getting to where the market is and then realizing market rents on Carter Oak. But Covington, we don't have to, we have TI dollars for the space and leasing commission dollars, but it's already a flex space. So we don't have to go convert anything or do any changes there.
And that's why we paid close to market for that one.
So we paid market for Covington, we paid below market for Carter Oaks, and we're going to spend that CapEx dollars to bring it to market. So in the end, we'll basically be net even between those two at a market. And we talk about market value, we're into it from a dollar per square foot that we're into the building would be $130 a square foot. And that's what we're seeing the market at.
Correct.
We have an investment return question for you. On the macro level, going forward, do you feel industrial flex is better for investors from a total return standpoint versus multifamily, office, or retail, considering the risk for each?
There's a lot of factors that go into that. So I think if we look at risk factors and we're looking purely at a risk-adjusted rate of return, so risk-adjusted rate of return, you really got to focus on like what are the main risk factors that go into it. When we compare our commercial and industrial to residential on a payment strategy during COVID and post-COVID, we have had significantly less issues to no issues on the commercial side, whereas the residential side has had a lot more challenges. That being said, the residential side has also had significantly higher rental growth over this year. We saw a report, CoStar was, Atlanta market alone was about a 15+% residential rental rate growth in 2021. That is, I would probably not sustainable as well. So I look at that as like, that's great. There's also 15% rental rate growth is probably not sustainable. So you have lower risk on the commercial side in the places that we're currently operating at. Total return, you got to factor in your appetite for, do you want current cash flow, or are you only focused on exit value, and what kind of debt options are out there? Debt options are medical. We've gotten a lot of debt under 3% in the industrial flex. If it's stable industrial flex versus a little bit of value add, we're still in the 3s. That's really attractive debt that we can tie down for a long period of time. You know, if rates are going to go up, I think we're,
Yeah.
we probably joke around about that too much, that like eventually they got to go up at some point, but maybe they don't. But industrial flex with the tenant base and the revenues we have there, we can get some really good debt going on at long term too. So is it, I would say it's hard to peg like which one is the absolute best right now, but I would mention in medical and industrial, the spread to what we can peg our cap rates at versus our cost of debt is about 5 points. And that's really the best that we've seen since we were first buying apartments back in 2012. So I would say to me that is indicative of like where there's opportunity if we're in at a cap rate or a yield in year 2. Once we've gone in and done some work, we're in there in a 7 to 8 yield, and we have debt at a 3.5. That is a very good spread. So we're happy with that.
Our last question is on webinar, so probably one for Dominique. For the upcoming flex deal in the Atlanta MSA for the 1031 exchanges, what is the timing for the webinars?
We will certainly send out specific details regarding the property that is officially selected with live stream details available. But currently right now you can aim for maybe mid-February.
We had one more question squeezed in here. Since Carter Oak is more of a value add, shouldn't investors be compensated for a higher execution risk and therefore see a higher total potential return?
I mean, we're optimistic in the return profile that we have on Carter Oak, so we think the return is pretty good. That being said, if it's, if it seems too risky for the rate of return that it generates ultimately, that's an individual investor decision. But when we look at Carter Oak and we see we're able to get to a market price per square foot and realize the market rents that are there, and see that value gain. That excites us, and all of the deals that we look at doing, that's what we want to see. So for us, we're seeing that as a good opportunity, and we believe that the investment returns to investors that are going to be strong for the life of that deal.
Great. Well, those are all the questions that we had come through. So we will stay on a couple more minutes as Dominique closes out for us. So if you have another question,
Yeah.
feel free to put that in the Q&A section.
Yes, thank you, Natalie. This does conclude our regularly scheduled program for the Industrial Flex Portfolio Market Update. We'd like to thank both our hosts, Dave and Avi, for providing those insights with us. And we do want to invite you for our last quarterly review live stream scheduled here in just 30 minutes or so, specifically covering our retail portfolio. We will add that registration link in the chat box located to your right of the screen. So we certainly appreciate you joining us today, and we look forward to seeing you soon. Bye-bye.